that is the only one, but apart from that, you don't have any large fireworks. But why are markets so volatile? I mean, is the volatility here to stay? If yes, what is the best way to make money when it will be difficult to predict the short-term direction? Yes, Naren, and complete expert of market behavior more than focusing on individual stocks. He's always got to take on the macros, and he's got a great approach as to how should one invest into market when it comes to the top-down thesis. Naren, good morning. Thank you for joining us. What do you make of the correction and the volatility? Is it Trump? Is it yields or tariff war?
Our belief has been that markets were not cheap, and we believe that markets. Everyone want markets to keep going up without any corrections. But the correction was a reflection that equity market always carries with it some volatility risks, and that's how we have looked at that entire correction. And even after the correction, markets particularly on the small and mid cap side are not cheap, and on the large cap side, while valuations are more reasonable, the next 2 years there is enough scope for volatility both globally and locally, which is the current situation at this point of time.
So you mentioned that pockets within small and mid cap stocks are still richly valued. Will it be fair to assume that we are not done with the pain yet and there is more selling coming for mid and small cap stocks?
I think people can't predict such things accurately, and that is the reason why investing is such a enjoyable activity, because there is nothing called perfect certainty. But the reality is that the markets are still not cheap on the small and mid cap side, and we can have bouts of volatility over the next 2 years due to both global reasons of interest rates going up in the Western world, as well as local reasons of various kinds of reasons for volatility over the next 2 years. That's how we see it, and that's why what we've been trying to do as a mutual fund is to recommend people to invest both in debt and equity, or choose categories like balanced advantage fund, which invest both in debt and equity together.
Naren, morning. Now I'll come to investments in a bit, but first on the market landscape, the recent fate of the state elections in Rajasthan, and then before that we saw UP and Bihar, is that there is a niggling worry for the markets, the fact that you can't take a BJP victory in 2019 for granted. Do you think that that's an overhang and it's on the mind of the markets for sure?
I don't talk specifically on politics, but I would say clearly there is a reason for volatility both globally and locally over the next 2 years, and investors should be cognizant of risk while investing in equity markets over the next few years.
So for an equity investor, then what kind of opportunities do you see in this market, considering that you believe that it is going to be a choppy ride?
See, clearly, even the way I look at it, large caps appear clearly much better than small and mid caps. The sectors which are focused on exports and sectors where there are low implied growth assumptions like power utilities are better than some of the sectors which are very, very sensitive at this point of time. And we do believe that from an equity market point of view, we are not at a phase at this point of time when you should take excessive risk, because for taking excessive risk you need fear and valuations being cheap, and in my opinion valuations are not cheap at this point of time, which is the reason the approach in equity has to be more measured than what I would believe.
Okay. Now you've been an advocatory of metal stocks and tech stocks. Both these groups have done rather well. 2017 was great for metals, and so far 2018 has turned out to be great for IT companies. But do you think now it's time to rethink anything which has got to do with global trade? If trade wars are real, then automatically it will have an impact on both inbound trade and outbound trade.
Metal sector, our view is that there are a number of companies which have deleveraged over the last 5 years, and now their debt to equity ratios are much more lower, and many of them are actually through with their capex phase, so they are actually in a deleveraging environment. And we believe that once you are in a phase where there is good free cash flow in any company, that stock tends to be more defensive, particularly if you look at it over a 6 month to 1 year time frame, which is the reason we are reasonably positive on the metal sector, and we don't expect that the sector can be as volatile as what it was 3 years back, except if you are investing in extremely leveraged companies.
Okay. You've always been a contra investor. Now, given that markets have been volatile, where are you picking your spots? Where do you think markets are not able to understand that the sector or that business could be at an inflection point?
See, clearly what we've been trying to tell people is the two contrarian opportunities clearly is in accrual funds at this point of time. And second, I would not say contrarian opportunity, but good risk return trade-offs are in the hybrid funds at this point of time, and categories like balanced advantage. These are the two areas where we feel comfortable at this point of time than any other category.
So Naren, within equities, any contra opportunities that you spot?
See, we have been overweight power utilities, we've been overweight upstream oil, and we've been reasonably positive on the downstream oil companies. So we think that, you know, as a strategy, invest in companies where the price to earnings ratio is low, dividend yield is high, and there isn't too much leverage. So that's our favorite metric at this point of time for the next few years.
I can't help but ask you about PSU banks. You know, it's so topical. Do you think that the pain is already in the price given the kind of sharp correction that we've already witnessed for the PSU banks, or would you say that there's still more to it given that every day we see new skeletons emerging out of the closet?
See, we've been selective in the sector for the last 5 years, and we continue to believe one has to be selective. And in my investment principles, when you invest in any leverage sector, you actually need to be careful of the weightages, because leverage sectors always carry higher risk than non-leverage sectors. So that's how we like to see the sector. So we would be selectively positive, but it cannot be a very big part of any investor's portfolio.
So what is a big risk? Will it be local? Will it be global? Do you think the risk for our markets is not going to come from domestic front? It is going to be global in nature?
See, I think the reason for recommending investing defensively at this point of time is all the risks that you mentioned are risks over the next few years. And till at least some of these factors we can say is already done with, there is actually potential for risk coming out of all the four reasons. If you look at the February correction, it coincided with a big fall on one day in US stock market. So I would say it's always going to be all these factors put together. But having said that, the easy phase to make easy money appears to be over.
Naren, lovely chatting with you. Thanks for giving us a flavor of how you're looking at the markets right now, some of your contra bets as well. So looking at a little bit of a further correction for the equity markets, there is no case to take higher risk in the portfolio, and looking at upstream and downstream oil marketing companies, but the time to make easy money appears to be over as of now, says S. Naren exclusively to ET Now.